Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my North American opening market comment for Thursday, September 8th. Well, the ECB kept rates unchanged as everyone expected. No surprise there. The big question was whether they would extend their bond purchasing program past March, when it's scheduled to end. They didn't make any changes there either, which is what I had expected. The surprise, though, was that ECB President Mario Draghi said they didn't even discuss the question. He also changed his description of the amount of stimulus. Previously, he had characterized it as adequate, but now he's saying it's substantial. And he said there wouldn't be any additional stimulus for the time being. Now, sometimes you just have to read between the lines. He could have used this opportunity to hint about what the ECB might do in the future. But instead, he did just the opposite. He implied that further action was unlikely. This may be an attempt to pressure the politicians to take action on their side by loosening fiscal policy, by reforming economies, and by taking other steps to boost growth. Nevertheless, in any case, it's bullish for the euro. In general, it looks to me like the central bankers all over the world, not just in Europe, but all over the world, are getting tired of carrying the whole burden of bolstering their economies and want the politicians to do their part. As for the U.S. indicators, today is oil day in the U.S. It's the weekly oil indicator. Oil inventories are coming out today. As usual recently, the market was expecting a rise in the weekly Department of Energy crude oil inventories, but a decline in gasoline inventories. However, the American Petroleum Institute statistics out overnight showed an incredible 12.1 million barrel fall in crude oil inventories. That sent oil prices soaring. The Department of Energy hasn't reported a fall like that since January of 1999. Now, if today's figure does come in anything like the 905,000 rise in oil inventories that the market was expecting, I'd expect oil prices to fall sharply. The API apparently also reported a 2.3 million barrel fall in gasoline inventories. That's much bigger than the 750,000 decline the market's looking for from the Department of Energy statistics. Here, too, a figure in line with the market consensus would now constitute a big negative surprise and send oil prices lower. Overnight, China's consumer price inflation is expected to moderate slightly. That might be taken as a sign that the authorities can afford, or might need, more stimulus. That could be good for the Australian dollar and other commodity currencies. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.